I guess we're live. We're live. Victor, we live? We good? Okay, cool. We live now.
We're live.
All right.
Happy Wednesday, Chris.
What's happening, Abby? You good?
I'm good. How are you?
Amazing. You got a new hairstyle every daggone week, huh?
No, I just changed it up a little bit, but it's the same hairstyle.
Come on. I was about to say, I guess I need to have dreads next week, right?
We should
I
try
need to do
that.
something, right? Change it up on y'all. All right.
Yeah.
So I'm excited for the week. I think we got some good stuff planned for today. Hopefully people have some good questions in the chat for us to kind of answer and stuff. So let's get on right into it, right? I know we've run a little bit behind. So Vic, go ahead and run our intro, right?
That's Hunter. That's Hunter.
Okay, we're back. Welcome everybody to Redline. I'm Abby Joseph, your tax strategist.
And I'm Christopher Bush, financial advisor, and we're gonna make it happen today.
Yes, let's go.
Come on. So what we got today? How we gonna start this?
I don't know.
We didn't even talk about that. Huh?
We should probably let's answer a couple of questions, and then we can go straight to teaching.
Okay, perfect. Let's do it. I know you got a couple of them up right for you.
Yeah, I think we have like one question. We had one question. A question that we had was, let's see.
And I literally just.
There you go. We'll put our question up here. Okay, so the question was, what type of deduction can a person who is single, no dependents, no properties, and no other known deduction to do decreased tax liability, has a six-figure salary?
Come on.
Ooh, that one's hard. Okay, so if you are single and you have no deduction, no dependent, you're not investing, you don't have a business, your six-figure is basically W-2, basically earned income, there's nothing really you can deduct. So you have an options of either itemize, you can do itemized deduction, or you can use the standard deduction. But with itemized deduction, you need to actually have more expense on the federal end, more expense. If you have more than what your standard deduction is, then you can itemize. Because if your standard deduction is better for you, then most likely your accountant is going to say, hey, it's better that we use the standard deduction instead of itemize. Yeah, so there's not really much that you can do. There's nothing really you can deduct. If you don't own any properties, you don't own a home, you have no children, you're not married, you're single, and we at six figures. Yeah, there's
perfect. I mean, it's just really just not very much that we can do, right? And that's the part that I have a lot of clients that are high income earners, but they're W-2 employees, and the biggest thing is as your income starts to increase, 250, 300,000, 400,000. I was sitting down with one client, they make 600K, right? But the problem is with making 600,000 and you're only getting a W-2 income. I mean, you're getting hit. I mean, easily with, 37%, right? Yeah. And there's not very much, like when you come to like, Crystal, what can I do? There's not very many things that you can do, right? Yeah. And I think that, again, going back what we mentioned so many times on our show is that that's why I really believe what comes to my clients, as your income increases, as you get a great financial plan, and you've got to probably incorporate some type of business strategy to kind of get ahead. If you want to diversify, right? But again, we can get to a point to where you don't owe as much, because if you are making a high income, it's great. So you don't have to do something extra, but it's just something that you always got to kind of keep in the back of your mind. What can I go do different, right?
Yeah,
Got to have that business side hustle.
I had a similar client, but she was a doctor, but she was on a W-2, but then she pivoted to being a contract doctor. So she became a traveling doctor, and they convert her from a W-2 to a 1099, which was kind of great, but everything has its ups and downs, right? So with the 1099, now you want to make sure you're paying what we're going to discuss tonight, which is estimated tax, or let's convert that 1099 to an S corp, so that you're not taxed on the distribution. So I would say yes, let's find a business or a side hustle to move. Let's move that income somewhere. I wouldn't even say business side hustle. If it is going to be a business side hustle, most likely I would say let's go towards real estate, because real estate has the best tax benefit to realistically when we're looking at tax code. So yeah.
So, well, I guess that kind of brings to interesting questions. And then again, this is I guess off the hip. You mentioned real estate, and that's something that I do, and I do enjoy and have real estate. I think that's where I got my entrepreneur bug from. My dad, since I was a little boy, we've always done real estate. He's always had a bunch of properties, and that's what I grew up doing. But I didn't really understand the benefit of having real estate probably till I was in college, right? I guess it's I guess not even pertaining to the show, but for me, I understand it because I got recruited to play basketball at Tuskegee. Well, then on signing day, the coach that recruited me got fired. I actually had an academic scholarship, right? So once they took away that academic, I didn't play my first 2 years, so I had to come in and actually pay $26,000 a year for Tuskegee, right? But the biggest thing is that why I understand that having some type of additional stream of income is that my father, we ended up selling a couple of our properties that we had that we did together, and I was able to pay for school. So I think that those are the things that are helpful, but until you're getting to the place about the things that we're talking about tonight, you don't understand how powerful building wealth and building real estate, and we'll talk about real estate investing. I guess that's another topic, right? That is so powerful to use. Again, not just, we're thinking about college savings and college planning. Well, that's actually a huge college savings plan there that we traditionally don't talk about, right? As real estate could be that. Business could be that to help expand your portfolio, right? But my question was, is there a way that people can, I guess this is for both of us, is there a way for people to get the tax benefits of owning real estate, but without actually owning it? Does that make sense? What about when it comes to like REITs, or if it comes to different way, there's different syndications online that you can always do to kind of be involved in a real estate transaction, but I guess they still wouldn't get the tax benefits on that, right?
No. So
they need to physically own the property, not own and they can't just be a part of a syndication, right? Because a lot of people ask me, Chris, I don't have time for real estate, but what if I'm part of a syndication that I can put some money in? That still doesn't give you the tax benefits of real estate.
It doesn't, because realistically, how are you receiving that income, right? A lot of those people are receiving a 1099, which Correct. They are being taxed on self-employment tax on it. So I would say the best tax code benefit for real estate is the passive income area, right? Yep. So you do have a W-2, you are working, right? But you use real estate for passive income. So the money that you are making from W-2, what are you doing with it, right? We're moving money. Remember, money was not, we have to see money. And this is why I said, I can't wait for us to start talking about having a relationship with money, because you have to see money as what it is, which is a tool. So it's not created to stay still. It needs to be moved, right? Yep. So if you are making that money in your W-2, let's move that money. Let's move that money into assets, so we can create a balance sheet, right? Let's move it into assets, and let's try to find passive income. Passive income is the best income. It's my favorite income, y'all. Besides portfolio income, passive income is amazing income. And passive income has the most tax benefits than any other income.
Come on. Yeah. Right. So I think Lonnie actually have a question early on in the chat. It says, if I flip a house and walk away from the closing table with $50,000 in profit, what expenses can I deduct from that $50,000 of capital gains? The home was bought and sold through my LLC. You want to read that one more time?
If he flip a house and walk away with a closing of $50,000, so whatever expense, like sales expense, like say for an example, if you had a realtor that you had to hire, so you have sale expense. You can also deduct any improvement that you've done in that property, right? If you had to pay sales tax, so you can actually deduct. There's a lot you can deduct, Lonnie. There's a lot that you can deduct from that to lower that 50,000. So then
like
you're not
gains.
taxed. Yeah, you're not taxed so high on it.
Yeah, but I mean, I guess as a whole, does that capital gains? I'm asking is if I was them, right? That $50,000 still counts as a full capital gains, but you were just able to knock it down based on our other expenses that happened within that transaction. Right?
Yeah. So let's just say we have $10,000 worth of deductions, right? That $10,000 is going to be subtracted from the 50. So his total capital gains on that transaction is going to be 40,000.
Gotcha.
Mm-hmm.
Gotcha.
So perfect. That's the goal. Yeah. Perfect. Just make sure, Lonnie, you kept your receipts and everything, and discuss with your accountant, so then you can actually make those deductions to lower Good that deal. Capital gain.
Good deal. Perfect.
Yay.
All
Did
right,
you have any other questions?
Not here. We got to make sure that everybody, use our email for us, because or Instagram, either way, but use our email. Make sure you guys are emailing us at help@thecomeupseries.co to make sure we're getting some questions answered, right? Because that's the biggest part of our show that Abby and I are doing, is that we want to make sure that you guys are getting questions answered, and we're just not, we're going to have our tailored teaching of things that we want to bring up, but we really want to focus our episodes and our show based off you guys' questions, because we, the more questions that you guys ask, it's a huge learning environment for everybody, right? We want to make sure that things are kind of moving along, but we're going to get into our curriculum and stuff like that. So, Abby, you want to kick us off on curriculum stuff tonight, or sure. You want me to go on one of mine? Or?
No, I'll be happy to kick you guys off, but but I do agree with you, because it is your scenarios that helps us put together how to teach you guys. So don't be shy about letting us know what are you going through right now when it comes to taxes or financial wise, so we can help you guys. Okay?
Yeah, I mean, things you heard or things you see. It could even be, a couple things. I know somebody sent me like different other YouTube videos. You want to send it, hey, look, can you talk about this? This guy's did. I mean, that's the part we really wanted to kind of get engaged with, to have some good dialogue and break some, we can be like Mythbusters sometime, right? We'll have a Mythbusters episode about what it is and what about it was it isn't. So guys, make sure you send us those emails. So boom, let's go, Abby.
All right, awesome. So tonight, what I want to talk to you guys about is estimated tax, right? What is estimated tax? Who needs to pay estimated tax? How much do you need to pay, and where and how often do you need to pay estimated tax? So estimated tax is used to pay not only income tax, but other taxes such as self-employment tax and alternative minimum tax. So and I love going straight to IRS publications, because it makes things more easier. Go here. There you go.
You're trying to get people used to reading the whole. Yes. Sometimes you go on IRS, right? But sometimes you're getting people used to reading the IRS and what's on it. Sometimes people skim over it, or we'll go to other websites.
No, go to IRS, Google University. No, I don't. I really want you guys to stray away. One of the things that I think I found that was not a little bit, but it was disturbing this year during tax season. I had so many questions this year that was based on what influencers said on Instagram or TikTok, or, what they read in Google. So I want a lot of what I teach you guys, I want to go straight to irs.gov, because I want it to be so little of my opinion, but what the publication is saying you can and can't do. So then you're not really saying Abby said this, but publication 505 said this. Does that make sense?
Yeah.
Yeah. So we're going to talk about estimated tax. So now, estimated tax must be paid. I think one of the biggest issues that I find is that as an entrepreneur, as a self-employment, and even some of you guys that are on W-2, I think we misunderstand how our responsibility when it comes to taxes. As you earn money, you're supposed to pay tax. So let's use a perfect example with your W-2. Let's just say you get paid bi-weekly. So every 2 weeks you pay in taxes. If you get paid every week, well, every week you pay in taxes. That goes the same if you are self-employed. If you're running a business, or you self-employed, or you are a contractor, you actually are supposed to pay tax as you get paid. Okay. So, but I was like, listen, we understand that you don't have to actually pay bi-weekly or every week, but you can actually do quarterly. So taxes must be paid as you earn or receive income during the year. I think we get spoiled out of the idea that we're not a W-2. So we just put taxes aside. But realistically, you're supposed to be paying taxes as you earn income. So if the amount of income tax withheld from your salary or pension is not enough, or if you receive income such as interest, dividends, alimony, employment income, capital gains, prize, and rewards, you may have to pay estimated tax payments. So my biggest thing tonight is for you guys, entrepreneurs or small business owners. I found a lot of clients this year that were I'll speak to some of my traveling nurse, some of my contractors that receive 1099s. So you making 200, 300, even $500,000 to $600,000 on a 1099, and you didn't make any estimated tax. Now you are paying tax in the back end. As a W-2 employee, you pay tax in the front end. As those other individual, as a subcontractor, you paying tax in the back end. Not only are you paying tax in the back end, you paying tax twice. So you paying individual federal tax, and you paying self-employment tax. All right. So if you are in business for yourself, you generally need to make estimated tax payment. Estimated tax is used to pay not only your own income tax, but other taxes such as self-employment tax, and, like I said, alternative tax. So if you don't pay enough, right? If you don't pay enough, if you don't pay enough taxes throughout the year, you want to make sure that you are keeping up with your estimated tax. Okay, so who must pay estimated tax? We said earlier, individuals, and that includes sole proprietors. That's like sole proprietors, single member LLCs, contractors, S corp shareholders. Those are individuals that are required to pay self-employment tax. All right. Now, who does not have to pay estimated tax? If you receive salary and wages, you can avoid having to pay estimated tax by asking your employer, to withhold more taxes from your earnings. That's another issue that I saw too on W-2. A lot of people was not paying enough tax. So it's important that you do reach out to your human resource and just tweak your W-4 a little bit. I always say it's always good to look at your W-4 around October, November, just to make sure that you look at your W-4, and you look at your W-2s, right? Your most up-to-date paycheck, and to see if you are paying enough tax. So if you're not, then at least it gives you an opportunity for the last quarter to make an estimated tax payment. All right. So always want to look at your W-2. So how do you figure your estimated tax? That's usually easy. You want to use the estimated tax calculator, and you want to also speak with your accountant. Don't wait till December. One of the biggest things I find that we do is that we wait till December. Taxation is a year round. Taxation is a year round. Taxation is not between January till April. It's not. If you are looking at taxation between January to April, you late. There's not much as your accountant that I can do, right? Because the planning aspect of taxation has already passed, right? So we should have been talking around July, August, which is planning time. And then I would say, hey, listen, you are a contractor. All right, we need to set you up for estimated tax. Or we could have the conversation of, hey, listen, if you are an individual, if you are a subcontractor, or you are under a 1099 and you're making 60, 70 or more, then we could have the conversation of electing as an S corp, right? So I'll use a perfect example. I had a client last year who made $450,000 as a contractor, right? He worked for the government and he made $450,000 as a contractor. He received a 1099. So my poor brother had to pay 30% plus 15.3. 52% of his income was taxed.
Wow.
That's heartbreaking. So, but we could have had that conversation around July. Hey, you have options. I love options. You have options. You could do estimated tax or let's elect as an S corp, because with the S corp, you're not taxing the distribution, right? The entity itself is not taxed. So we could use a perfect example. I love a calculator because the calculator is my favorite tool. Let's just say he made that $400,000. Let's just say out of the $400,000, he paid himself $250,000. That $250,000 was on W-2, right? That $250,000 was on W-2, so he's already paying taxes on the $250,000. So we have $150,000 left. Out of the $150,000, let's put $60,000 on a solar 401k or SEP. Right? That leaves us with $90,000. And with the $90,000, let's just say we have $30,000 worth of expense deduction. So now we're deducting $30,000. That leaves me with $60,000 that I'm going to be taxed on the federal.
Yeah. So, and that's, I mean, so what if, you talked about earlier on our real estate side, if that's the same thing, if you have additional money that you may potentially pay to IRS, how could you go and say, okay, maybe I can buy a property, I can buy something else and actually depreciate even more?
Say that one more time.
If you can have additional tax deduction, right? Yeah. Or just an expense by investing in real estate, if you still have additional money left over, yes. Right?
Yeah.
If you're going to pay to the IRS, okay, we got to go buy something.
Because realistically, right, that $95,000 that he had to pay to IRS, yeah. We could have done so much with that money. Yeah. We could have done so much money with that money. So I say to you, planning is everything. So when you look even with estimated tax, not that I'm not a fan of estimated tax. I feel like I like to know everyone's scenario is different. We may go to the estimated tax route, or it may be better to just do the S corp, because S corp eliminates the 15.3.
Yeah.
No. So now all you would be responsible for is what? The $60,000 on a federal level. So the $60,000 on a federal level puts us where in the tax bracket? At a huge lower tax liability, right?
Good stuff.
Yeah.
Good stuff.
So when it comes also, you want to make sure you use the calculator when to pay your estimated tax. So there's 4 payment periods, guys, that you want to make sure that you are aware of. Those 4 payment periods, I usually like to start at the 4th quarter. Don't ask me why. So between September to December 31st, so January 15th needs to be your first payment. January 15th, then January 1st till March 31st is due on April 15th. So next week, your estimated tax is going to be due. All right. So you also have from April to May, June 15th is when your next estimated is due, and from June 1st to August 31st, you have your September 15th. So so it's 4 quarters in a year, and you want to make sure that you do. Here's another thing. Let's just say you were supposed to pay estimated tax, and you didn't. When your accountant completes your tax return, guess what is added into the return? Wow. Estimated tax penalty. You are charged a penalty for not paying your estimated tax. And not only that, let's use that $95,000 example again. Who has $95,000 just sitting somewhere to give IRS? So let's just say you don't have the $95,000 to pay. What are we stuck with now? We're accumulating interest, which is 5%. And IRS accumulate interest daily, Christopher, daily.
Come on.
Daily. So you're paying this huge interest, which is 5% of this $95,000, and you're getting charged the penalty. So it's very important that you are paying your estimated tax on time. Very, very, very important, guys. Okay. So like I said, penalty for underpayment of estimated tax is does really, 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 really hit you bad. Okay.
So let me ask you
So
this: well, before you go on the estimated taxes, is that something for? And again, I'm asking for the community, right? Is that something that your CPA, your accountant, they should be keeping up with that for you, right? I mean, I guess that's the biggest thing of why you need to have a tax strategist, you need to have a CPA or accountant. Like they should be keeping up that's their job, right? That's something that as a business owner, you shouldn't have to think about,
no.
hey, all these things, right? That's why we have to have a team in place. So me as an advisor, you as a tax strategist, like we have to have those pieces together because that should be automatic from your account. That should be automatic. Hey, look, April 15 comes around. We understand that there's this bill needs to be paid. This bill needs to be paid, right? I mean, and being like that part is huge. That you have to get those things off your plate, but have a team together to put that in force for you.
Yes. So one of the good question Antonio says, so if you are a day trader, you need to be paying your taxes early. If you are a day trader, I'm gonna give you guys a gem. And that's not just for day traders, right? For all of you, for our contractors or what do we call them? Contractors, self-employed solo proprietors. If you are making a lump sum of money, right? If you're making good amount of money, create a saving account and call that account tax.
Yeah.
Create a saving account and take a percentage. Like I'm gonna be 100% with you. I pay full transparency. I pay estimated tax. So one of my account is from a stop. One of my account is a tax account. So every quarter, I don't have to take money from my operation account to pay that. It literally comes from the tax account. So it automatically, it's a recur, it automatically comes out from the tax account. So as a trader, right, if you're making good amount of money in the stock market, use that saving account, right? A lot of my realtors, we do that. A lot of my realtors, they do that. So they put away 20%, right, in the tax account, and they make their quarterly estimated payment. That's what I would suggest for you, Antonio, as a day trader. Yeah.
And that's huge. So, and if you're setting aside in that account at 20%, I guess sometimes people, well, Chris, I got cash that's sitting. I got cash that's sitting. It needs to grow. Well, again, not all accounts have to have a growth feature to it, right? No. Now, but however, with rates right now, honestly, right, there's different type of money markets that we can use. There's, again, we talked about earlier. There's different, you can even do like a CD ladder. You can do a T-bill ladder. You can do different conservative places to where, okay, you may be able to squeeze out a 2 to 5% interest on that money during that time. If you do, great. If you don't, it's okay as well. The biggest peace of mind that you got to have is that 20% is there and it's automatically off the top. You're not spending it and it's 100% ready to go. You're not stressed about it.
You're not stressed. At the end of the year, you're not taking a lump sum out of your money to pay IRS. That's like my realtors, especially my realtors, when they do this at the end of the year, it's a relief. And it's never as much as they pay. Yeah. Realistically.
Exactly. And that money can be rolled in and go to the next one. I know I wanted to scroll up, or I saw a question from Mark. He threw out a question, right? He's going to always throw out something. Is that how would you prepare yourself when your company is about to be acquired tax-wise, and after the checks clear, what should we put that capital? Now, I'm assuming it's okay Mark, I'm assuming if it's a company that you own, right? And you're going to get, let's say, you're getting a buyout, and they're giving you a lump sum check, I believe, right? Is that probably what he's asking? You're going to get a check for that transaction. Now that whole transaction is a form of a capital gains, correct? So, I think I have a way, but I guess we can kind of talk about it. Well, what are some of the things? How can somebody prepare themselves for that type of windfall?
I would say to one, to put a portion of it aside for tax. It's so funny. We're so focused on making money, which I love, right? The idea is to make money, but Uncle Sam has to have their piece. As long as you have that in the back of your mind, whenever you make money or whenever you come up with a lump sum, depending on what type of income it was, Uncle Sam's going to have their piece. So what I would say the best way to prepare about that, you want to inform your accountant in advance. So then your accountant can go over the options that are available to you, right? And maybe it's an opportunity where, you're already at a high tax liability. Let's move that money. Let's move that money prior to tax season. Let's move that money to some pre-tax contribution. I'm probably telling you, you need to speak with Christopher. I'm probably telling you, hey, have you ever thought about real estate investment? You know, we're putting together a dialogue so we can see what is going to be in your best option to not have to give IRS a lot of that money.
Yeah, and I guess there's another way we can even look at it. So there's some couple different tax strategies. Again, I'm not a tax advisor, I'm not a tax advisor, I'm a CPA. But again, my job as an advisor, I'm kind of like a quarterback. But if somebody's selling a business or selling a company, right, there's also maybe you can use our IRC code 453. I'm sorry, 450. Yeah, IRC 453 code, right? Otherwise called a deferred sales trust. Okay. I don't know if, we haven't talked a lot about that. But on one of our upcoming shows, I will bring one of my colleagues that, we kind of do business together to facilitate a sale, right? Because there's a way for you to have a sale of a business, a lump sum or a windfall, but have a trust involved to where you can actually push those capital gains into the trust and not pay taxes on a sale. Okay. Now, however, when you start to withdraw money from that trust account, then you would pay taxes on what you withdraw, but not on the total amount. So that's, that's kind of going, but that's called like a deferred sales trust. There's a thing called a Delaware sales trust, which is totally different. But that's additional way for business owners to actually shield themselves. Again, you're still gonna have to pay taxes, but you can push that taxes down the line. I kind of like to work like a 401k. Right, that you put money inside of a 401k, but it's tax deferred, so you only pay money when you pull it out. So that's another kind of strategy that you can use, but you have to have the right team involved to put that in place. Like that is a deal to where you got to be, liquid sales, like it's got to be set up correctly to do a deferred sales trust, and to eliminate those, again, not eliminate the taxes, but again, you can actually push those taxes onto the trust. And then when you take distributions from the trust, that's the only time that you would need to pay capital gains on that. But that's kind of like a summary. But Mark, that's also another way that you can kind of prepare yourself tax wise and not have to relinquish all that money up front. Right. And then the other side of it, money that you do need, again, it's going to go into a financial plan. It's going to go into, okay, the next business that we're looking for, or it's going to go into, okay, well, if I'm ready to retire now or be financially independent, okay, well, there's going to be different accounts where I want to make sure I can get income for life on. Right. So I think that it's a lot of different ways you want to chop options. It's, that's one of the ways that we've done previously is on a deferred sales trust. So it's also amazing.
Yeah.
Yeah. Let's see.
Ron say taking tax advice from influencers will get you clapped by uncles. Yes, like just red flags.
Yeah, I don't want to be honest with you. I don't really think that it's just like it's not necessarily like influencers are bad, because at the end of the day, I mean, we're on social media, we're influencers, I guess. But I guess we could be kind of. So I just think that it's about understanding the whole story, right? Because again, a lot of times we're with Instagram, with social media, even with us on YouTube, like we'll talk about ideas, but that idea has to be complete. Okay. Because sometimes we only talk about part of the strategy. Sometimes we don't give anybody the background on how the strategy came about. So it's not just that the advice from influencers are bad. It's just that you have to know the whole story, right? You just can't say, hey, look, well, I heard this and I needed to apply it to my personal situation. Sometimes your personal situation is not going to help.
Not aligned. Exactly.
It's not that the influencer did something wrong or they said something bad. It's just that it doesn't work for your personal plan yet, or it may not work for your plan at all, right? And we got to learn the full story and those details, right?
Right. Let's see, Abby, please tell us how to pay $700 in taxes like good old Donald Trump. I'm ready to make moves. I actually want to pay half of that. Well, I'm gonna give you a little story. Donald Trump accountant is in prison. Donald Trump is not in prison, but his accountant is on prison. Sorry, I can't be your Donald Trump accountant.
Right.
Ron said,
I guess what you're saying, you got to have a fall boy.
Listen, exactly. No, thank you. If you work a W-2, let me see. Okay, Ron has a question. If you work a W-2 and a 1099 to do extra withholding on the W-2 every 2 weeks to cover most of all of your 1099 tax liability, you must know your numbers. So, it won't work. Just my thought. That's true.
Yeah. Again, if somebody has W-2 income and they have 1099 income, on that 1099 income, just say 20, whatever you make on that 1099 income per month, just say 20%, put that in a separate account. And that will cover it. So it's not about, you don't need to manage your W-2, withholdings or elections on that side, right? It's not about the W-2 side, it's about the 1099 side. So if you're getting paid from 1099, have an account, take 20% off the top, whatever you get paid, put that in a separate account, right? And then at the end of the year, it'll all come out together the way you need to be.
And that pretty much answers Veronica's question. I would put between 15 to 20% aside. Yeah.
And it seems like it's like, man, dang, you don't get paid nothing. When I get paid, I got to take off 20%. Like it just, when it started getting chopped up.
Right? Every time I look at my numbers, I be like, listen, when can I go back home?
Come on. Right.
Where can I go back home?
Is that what you said for Veronica, right? So
yes, about 15 to 20%. Okay. Mm-hmm.
Perfect.
Yeah.
Okay. All right. So what else we got? Is that all?
That's all I have, you guys, for you guys when it comes to estimated taxes.
Cool. Yeah. So I think so for me today, there was a question about, I was going back, I was talking to Mark and he was like, man, you haven't answered all the questions that came in. I'm like, well, I thought, we've had quite a bit of them. However, one of our good friends, Miss Beverly, she's actually been keeping like a running tally, right? So of different questions and topics that come up during the show. So I went back to like the first bullet point that she had. I know we talked about this briefly, but I kind of want to hit on another point because this week I actually had two of these examples. Okay. She said there was a question about employer sponsored plans, the breakdown, the different investments and investment types and how to choose it, right? Because again, if you have an employer sponsored plan, okay, or a retirement plan from your job, you're going to get multiple investment options. Okay. And what I found out, what this question's about, this client is particularly, they have like a target dated fund. Okay. So one thing that I want to give everybody homework on is if you have a retirement account, 401k, 403b, 457, TSP, right? I want you to go inside and number one, make a note of what you're invested in. Okay. Because if you're putting in money, we got to know what it's invested in. So one way that you can invest money, let me see if I can pull up my, my deal real quick. I can make a slideshow. Why doesn't my slideshow coming up? Okay, maybe I'm gonna do it this way. All right. One way, again, we have a target dated fund, and I know we talked about this briefly, but we're gonna go over it one more time. Okay. So on a target dated fund, if you guys don't know, right? Because most of the time when you have a 401k plan, this is like the first thing, this is like the default option is going to be in a target date. Okay. So what happens, like if there's a target dated fund and it says that you're going to be retired in like 2050. Okay. So what happens is heavily invested in equities in the beginning, but the closer that you get towards 2050, right, it's going to be transitioned to more fixed income investments, right? So it starts off aggressive, then it automatically gets more conservative. Okay. So one thing that I want to kind of let people understand is when we're looking at target dated funds, we got to understand that we have more options inside of our 401k. Okay. So this is what I pulled up from one of my clients today. Right. So I don't know how I can blow that up. Maybe I need to blow it up on my side. Right. Okay. I don't know how this works. Okay. So if we look at this is like in Power. And again, this is not investment advice, guys. I'm just going over an example. Right. So don't think that this pertains to you.
Don't quote you. Don't quote you.
Example on how things work. So what I wanted to show you guys is when you look at the option. So inside of your 401k, right, or your report, you're going to have a link that's going to show you all the investment options that you have, right? Well, most people are going to be in a target dated fund if you not have customized it before for yourself before. Okay. So when we're looking at target dated funds, I want you guys to understand, again, they're not bad, but it's just set it and forget it type funds. But sometimes I'm not really a big fan of the performance all the time. Okay.
Okay.
So when we're looking at this line here, it says a 10-year inception, okay, of a fund. Can y'all may not even can see that. Can y'all see that? How can I
can see it? It's tiny, but it's okay.
Okay, cool. So let's just look at it. Somebody was like, they set a target dated fund of 2050. Okay. So when we're going all the way over here and we're looking at the 10-year returns, right, or since inception, This has been inception since 2011. Since inception is about 8.28% rate of return. Okay. So again, it's a decent fund. Boom, that's what it's done over the last, since 2011. But however, inside of everybody's 401k, right, you're going to have options outside of that to where you can customize your own portfolio, right? I think I talked about before. It's a difference from having, the easy mac and cheese and you add water versus you building a portfolio yourself. Right now, and I don't suggest you build it by yourself because I use different tools on my side to do the research in my client's 401k plan. I'll put all their funds that are available. I'll put it into software. I'll do extensive analysis. Okay, what funds should we use based on their age, their risk tolerance? We do all of that when I'm with my clients. Okay, so this is even not something that a lot of you guys can do by yourself. Right. But if you have some good software and a professional like myself to work through this with you, you can come up with a great portfolio. OK, so even if you just look at from a large cap perspective. OK, so from a large cap perspective, this growth fund with Putnam, right, has averaged like a 14.25% rate of return since like 2012. Right. So if you're in a target dated fund, it's getting like an 8% versus you can say, hey, I can just choose this one large cap fund as average of 14%. That's a huge difference over time.
Yeah. Oh, that's
right. If you look at any of the most of the, from a small cap, mid cap, large cap option, most of the individual funds will have a history of performing a lot better than target dated funds in the past. Right. So see, that's why it's so important. Important to see how can we really build a portfolio and customize a fund that fits you. Right. So think about this. I'm gonna kind of show you just on the calculator how like important that is. Right. The big difference. So let me share one more thing on here. Let me share my screen one more time.
So that while you share your screen, so what you're saying is, listen, I'm gonna pull up my 401k. And I'm going to look at which is performing the best. And I can just move the majority of my funds to what is performing the best. No?
It's kind of sort of yes, but it's not that simple because I'm just going to pick the best funds that have a 10-year track record or on that one. So for me, when I'm doing an analysis, it's going to be more going into it than that. Okay. Because I want to look at the mix. I want to make sure, do I have what small caps am I using? What mid caps am I using? Am I going to use some international? Right. It may not be the best performing fund per se on a percentage wise, but maybe it fits that mix right now. Right. Maybe it's based on the state of the market right now. Does that make sense?
Yes,
so it's just not about the past because past performance doesn't always predict and will not predict future gains.
Absolutely.
Okay. But it's kind of like a benchmark for us. So that's why it's just more than just picking like the best funds on the backside, because sometimes I may not pick the best fund that's been on a 10-year track record. Sometimes, I know enough about the managers. I know enough about this fund that maybe performed well over the last 3 years. I may pick that one. So it really depends on a lot of different things. And that's where it's so important to where you use, you work with an advisor or you use the proper tools to build that portfolio. Okay. But what I wanted to kind of show is this, just how it makes a difference over time. Okay. How allocating your portfolio over time and not just your 401k, but all the different type of accounts that we've always talked about, the allocation of those portfolios are so important. Okay. So let's look at it here. So let's just say if somebody's brand new from a 401k, and let's say that we're investing for a 30-year period. Okay. And let's say the portfolio is getting like a 8.28% rate of return. We'll say an 8% rate of return. Okay. Well, I'll say 8.28 because that's the one on 2050 fund. It's done. Right. And we'll say somebody's contributing maybe $500 a month to that account, to their 401k.
Okay.
Right. So when we're looking at that, let me bring it up here. When we're looking at that over a 30-year period, that's about $742,000 that it would actually achieve. Okay, which is good. However, and again, this is just an example. This is not a perfect world, but I want to show you guys the impact of working with an advisor or making sure that you have a customized portfolio. What a big difference it can make. Okay. So what if we're able to build a portfolio, and I'm just going to use something simple. I'll say, like this one fund here with Vanguard, it's a dividend appreciation fund. It's averaged like 11.24% rate of return. Actually, let me give you one since this one. So this fund here that I'm looking at since 1993, okay. This is it's an iShare fund. It's averaged a 12.21% rate of return since 1993. Okay.
Oh, that's nice.
Right, which is pretty decent. Okay.
Yeah.
Well, think about this. So again, off the same amount of money per month of you using a target dated fund, in this case, hypothetically, you using a fund that's actually that another fund that's available inside your 401k, you would pretty much have doubled your money.
Exactly.
Right, that's $1.5 million versus 742, just by understanding what funds to pick, just by understanding your risk tolerance, by understanding, okay, well, I can't just pick what the company gave me. The company never gave you, you never had a conversation with an advisor at the 401k, right? They never put together a customized portfolio, right? So when people tell me, right, oh, well, I just kind of picked what they gave me. Well, it's more than that to it. Okay, that can make a huge difference, right? And then I think the last part of that as well is that not only just understanding your options inside your plan, with your baseline options, with your large cap, mid cap, small cap specialties and other investments, but sometimes your 401k plan may have a self-directed option. Right, to where, okay, well, what if you want exposure just to Apple stock, or you want exposure to Tesla, you want exposure to individual positions? You can actually have that inside your 401k. But again, most of my clients that I do these consultations with is they have no clue that can even be a possibility.
Yeah.
Right, and that could be the difference, right? If somebody's saving $200 a month, right, and they've been working there for 20 years, they could have had double the money, which would increase their guaranteed income if they would have understand their options. Okay. I remember what was this? This was 2013, Abby. I'm sorry, 2018. I had a client. She was retiring from LA County. She said, Chris, I don't understand, my plan has not been growing since I've really been there. Okay. Well, this is the first time I met her. She's already been working there over 20 plus years, about to retire. When I looked at her statement, I found out that she was just in the stable value fund for her entire career.
Wow.
So basically, she was in a money market fund her entire career, had around $200,000 saved up. She was a great saver, but nobody ever explained it to her. Unfortunately,
she never grow that money.
She never maybe reached out to any advisor, and maybe not attended the seminars. But she was just constantly just saving. But to save $200,000 pretty much that's good money.
Yeah.
So when I showed her, if she would have understood what we went over tonight, she would have had over $800,000 to $1 million in her portfolio because the way she was saving.
Yeah.
Right. So that's one of the biggest homework pieces that I want everybody to do with their plan. If they have not done a review of what their current 401k plan offers, as far as their funds within inside of it, and just not being, okay, I'm just going to only do the target dated funds and look at your other options, and don't pick all of them. Right. I had one client, she had literally 18 funds inside the 401k.
Oh, wow.
Okay. So we don't need to choose every single fund that they offer. Right. More than likely, this is me, Abby, when I'm looking at a portfolio, the most I will ever kind of put inside a portfolio is maybe 6 funds at the most. Right. And
it's good to be able to manage them, because you want to be able to do research in those securities.
Yeah. Right. So again, the biggest thing is again, you don't overwhelm any portfolio. We talk about diversification a lot, but guys, you don't have to have 18 or 10 funds inside your 401k plan. Right. No, you don't have to have that many funds inside your other personal. How does this work with annuity funds? Okay, hold on. Let me get to that, Greg. It's about concentration sometimes, right? So that's why at most 6 funds, a lot of times I'm only going to probably use 4, and almost 80% of the time I'm only using 3 funds. Okay. If somebody's just now starting brand new, I probably maybe only choose 1. So see, those are the things that, you're not going to get from your employer necessarily. If you just go pick it by yourself, just don't get overwhelmed with just doing, every single open-ended fund that you think that performs well. It's definitely a science to it. Okay. And that's what we're here for, right? To make it happen.
To make it happen.
So I think we had some questions on that. What makes what we do. Well, thank you, Ron. Yeah, so we're both fully, we're both licensed to do this, right? Not just influencers with no license. That's why some stuff I can't even talk about.
I don't. I stay away from them. The company I work for doesn't match my full 401k or Roth, but Robinhood does match 1% on IRA and Roth. Should I allocate my funds there instead?
It depends.
Yeah, it depends.
So I don't think
different.
So I don't think it's an either or scenario. I'm sorry, it's not a either. No.
If one is better than the other,
right. You can use both. I'm getting you something, all right? You can have both. You can have a situation where you can do both. Okay. Yeah. So if your company does not match, right, but you still need a tax deduction, Abby, I would still tell somebody to contribute to the 401k because your Roth IRA is not going to give you a tax deduction. Right. If you make too much money, even putting the money into a traditional IRA is not going to give you a tax deduction. So sometimes I'll tell a client, even if they don't match, but if you owe the IRS and you're a W-2 employee, you don't have a business, you don't have any other type of deductions, yes, I would contribute to your 401k.
Just leave it to your job 401k.
But I would also put some towards the Roth IRA, of course, so you can get a match, right, on your IRA. So it would be both, right? I would do a little bit to my company so I can get a tax deduction, but I would still max out my Roth IRA, right? Because it's free money. If somebody's gonna give me free money, I'm gonna take it. Okay.
Any day.
Right. I'm gonna take it.
Day. Brandon had a good question. Was it Brandon?
What was it?
When investing in startups, will it be better to use an LLC or an IRA?
Okay, so when investing in startups, is it better to use an LLC or IRA?
Yeah.
I mean, I guess I don't know. Maybe I need some more detail on the question, but
why would you want to use your IRA though?
Well, let me ask you. So, kind of like what we talked about last episode.
You're investing in it.
Well, so let's just say this. So, let's say if you have what we talked about last episode, like with a self-directed IRA. Let's say if you had a business that you did want to invest in, let's call it real estate. Right. We talked about this last week, right? If you have a business that you want to invest in, like real estate, somebody can use a self-directed IRA to invest into that business.
Yeah, you can.
Okay. Right. So you can use it, you can do that. Now, when it comes to an LLC, I guess what's better. I mean, LLC, you're not
okay, so
you're not putting a box. You're not putting a box with an IRA. You got to put the profits back into the IRA.
Yeah.
You can't take it out, or you're going to get a penalty. With an LLC, you can do whatever you want with the profits.
It's your money. But what also too with an LLC, there's two things, right? There's two things what an LLC does. If you ever ask a business attorney, they'll tell you what an LLC does is two things. One, it's a protection. It's a limited liability, right? It protects your personal asset. Two, it's a tax benefit. That's it. The IRA, if you want to use that IRA, realistically, your money, I won't say is in bondage. Your money is in a place where you can't, it's not accessible. It's not accessible for you to take whenever you want. Yeah. You can, but then you get penalized. So I would say look into a scenario, but if I did my startup is going to be under an LLC. Yeah. Not my IRA, personally.
Yeah. And again, I think it's based on the situation, right?
Yeah.
Because for instance, so I'll kind of give you another story. Like I did have a client that they were retiring from their job. Mm-hmm. Okay. They had over $500,000 in their company 401k. Okay. So what we did, we actually rolled that money over into a self-directed IRA because they were wanting to retire from their job, but they wanted to actually invest into a franchise.
Oh, that's nice.
Okay. So what the good part about it is now they didn't have to use other money or cash, anything else. They didn't have a lot more, but they could use their IRA, their self-directed IRA, and to invest into that franchise, and they didn't have to get any penalties or taxes by using that money.
Exactly.
Okay. So she was able to use over $100,000 to invest in her new business, in her franchise, using her IRA. But again, they still had an LLC separately to use as well, right? So I mean, again, all of these things work the same. It's a lot of times with finances, it's not one answer. It's basically a solution that comes together.
And it's not just a solution that comes together. I always find it like it's a journey, right? What is your journey? Because my journey and Chris' journey is different, right? So even though we may want the same thing, but we may not want it in the same route. So every individual scenario is going to be different. Yeah. So I always say it's so important you as an individual to sit with your accountant and to sit with your financial advisor and be like, this is my scenario. This is this is what I want. This is my goal. This is where I want to go. And then you can actually create that portfolio that looks just like you.
Yeah.
That's
I wish Mark would like come up with some AI deal to do all this, automatically,
Mark, you're gonna come up with this AI to just like do everybody's tax return? So I could take like 2 months off.
Come on. Right, we're gonna get there, right? But
we're gonna get there, Chris. We're gonna get there.
Yeah. So
hey, tonight was fire.
Yeah.
You did an awesome job tonight, Chris.
Yeah, you did as well, Miss Abby, as always.
So you back home?
I am back home. I'm done traveling, back home. Yeah, it's like for these next 2 months, I'm gonna do my best to not travel as much. I gotta be in the lab. I'm working on some pretty cool things, not only for the show, but also for my business and stuff to kind of help everybody else. So yeah, it's that season. Like you gotta lock in sometimes. You gotta lock in. You gotta. Freedom is great. I think that's one thing that we don't talk about enough as well. Like coming from corporate America as an engineer, Abby, like I never would have imagined the freedom of running a business and do what I do today would bring me so much joy, and I don't know, it's kind of hard to explain, so I really encourage anybody, right? I really encourage anybody that has that entrepreneurial bug, if they have something that they want to do and, take that leap of faith to do it, because it's worth it, right? All of this is worth it to be free, to have your own business and, do what you want to do when you want to do it. But it's also a grind, right? You give up the 9 to 5 for 95 hours a week plus in the beginning, but it's just so worth it, So I just want to encourage anybody out there.
Yeah, I couldn't agree more. I've been running my firm for over 14 years. And I would say that it was the best decision I ever made. I was able to raise my daughter how I want to raise her, and the freedom it gave me that. Now, I'm gonna tell you guys this: entrepreneurship is not for the weak.
Yeah.
Don't come in.
It's not for everybody.
It's not for everybody.
Sometimes I feel like it's not for me, right?
It's not.
Some days I'm like, this is not for me today.
It's not for me. Listen, I quit every day. I quit every day and wake up the next day and just love what I do. And it's so funny because I'm the middle child of 3, right? And my sister loved corporate world. She's in management. She loved corporate world. She loved wearing her suit and then manage a group of people. And my brother is in tech, but none of them would ever desire entrepreneurship. So I became it.
Yeah, that's it. So.
Yes.
Awesome.
Kudos.
Right. Charles said you must be the most spoiled child, right?
Realistically, I'm gonna be 100% transparent. I am the least spoiled child. You could ask any of my siblings; they'll tell you the truth. Abby is the least spoiled child, and that is because I'm the middle child. Middle children don't get attention, y'all. Like my brother's mama's boy, and my sister's daddy's girl.
Wow.
See? Middle kids don't get, we independent. Middle children are always independent.
Wow.
I think we have one last question before we end. Greg says, so how do annuity funds work?
Okay, so it really depends on what type of annuity you're referring to, Greg. So when it comes to, it may be are you talking about like a TSA, a tax sheltered annuity? Give me a little bit more information on that. Right, if you can, real quick. There may be something that you need to email me, Greg, but I can kind of give you, because there's multiple different annuity funds. The main thing that with the annuity funds, just period, if your company has a variable annuity as a 403B or a TSA, just understand the fees and expenses on that are typically really high. Okay, and sometimes they have income riders on those that make it even more expensive. And if you're not focused on retiring yet, you don't need an income rider on that fund. Okay, so sometimes you really got to understand how that annuity, the annuity works inside your retirement plan, and understand that expenses are going to be a little high, but sometimes they perform well, right? There a lot of times they're meant for a guarantee, and it's typically somebody has that if they work for a school district. Greg, you work for a school district?
I think Greg should email us his scenario.
Okay. Maybe he left us.
Greg,
Maybe took too long.
Email us your scenario. I like to see how you. I like to have a picture of how your scenario looks like. I got to ask my job because I don't know. Just wanted to know what's out there. Okay,
great. Yeah, okay. Just log into your account, figure out what we got, and that way we can set you on the right pace, my friend.
Yeah, definitely. Hey, Michelle, middle child. Yes, I'm so with you. And Uncle Charles, you're terrible. I remember. I was in Atlanta, and so Uncle Charles met my family. So Uncle Charles met my mom, met my sister. So you saw me at the dinner table, right, Uncle Charles? I was not spoiled.
Yeah, my sister would say that I'm spoiled. I'm the youngest, so but
you're the baby. Oh, you spoiled. Yeah,
she would definitely say I was spoiled in the baby.
You spoiled.
So
guys, thank you so much for showing out today, and thank you for bringing all your questions. Don't forget to email us so we can actually put a picture together for you guys, so Chris and I in the back end can continue to work to bringing you guys bougie as all get older. So Chris and I can actually put together what you guys are actually needing. And Chris, you rock today.
Appreciate it. You did really well, Abby. So let's get it. Another episode. So I'm Vic. I guess we gotta do the outro.
You guys have a wonderful day, guys.
Take care, guys.
Bye. Peace.
Peace.